Hi folks, I'm Drew B, and if you haven't heard, on Tuesday, Charles Schwab and TD Ameritrade both announced that they're completely eliminating commissions to trade stocks, ETFs, and options. Now this follows in the footsteps of Interactive Brokers and of course Robinhood, but $0 commission investing has gone mainstream. And I'm going to tell you why that doesn't matter, or at least why it shouldn't. Stay tuned. But before I get into that, if you'd like to know more about taking a balanced, prosperous, focused approach to modern life, think about hitting that subscribe button. Gently or inappropriately slap that like button, and if you've got an itching, burning, yearning sensation to know more, then tell me what you'd like to know more about in the comment section below. With that, let's get started. Briefly, let's talk about the brokerages. For Charles Schwab at least, this isn't likely to have a huge impact on the bottom line. According to an analyst estimate reported by CNBC, Charles Schwab got around 8% of the revenue from commissions, and their CFO himself estimated this change would shave a net 3 to 4% off quarterly revenue. Not huge. But for TD Ameritrade, it might be a bigger deal. They got around 28% of the revenue from commissions, and now that's gone. Fidelity and E-Trade were expected to match the $0 commission pricing, and indeed, while I was filming this, E-Trade did announce that they will also be matching that pricing. I don't know if anybody expected it would happen this soon, but it's hard to say the industry didn't see this coming. The biggest loser, though, may be Robinhood, because now they've lost their biggest differentiating factor. So why shouldn't this matter for us? First of all, if you're using a small enough amount of money or trading frequently enough that a $5 commission made a difference, you need to be honest with yourself and ask whether you're investing or gambling. $0 commissions are like a Vegas casino advertising you get 2 free drinks if you play bingo. You're still in a casino, you're probably going to gamble, the odds are in their favor. Feel free to write anything you want in the comment section below, but before I get a bunch of hate comments from people who claim to have made an inordinate amount of money by investing in individual stocks, let me say, I am not a professional. This is not investing advice. This is my own personal opinion for entertainment purposes only. If you have questions about investing, you should consult a qualified professional, not some dude on YouTube. If you have made a better long-term return than the market as a whole by investing in individual stocks, good for you. But you're the exception, not the rule based on what I've read. I'm merely summarizing the research, and most of what I've read shows that the average investor would be better off taking a passive indexed approach than actively trying to pick stocks. To hammer the point home, when you invest in individual stocks, there's always this temptation to try and time the market. And with $0 commission stock trades, that's going to be even harder for a lot of people to avoid. Thing is, studies show that the portfolios of people who try and time the market have lower returns than the market as a whole, often by 1% or more a year, and that really adds up. As Money.com pointed out, the cost of trying to time the market will dwarf the few bucks you're saving on a stock trade. Secondly, investing in individual stocks is based on the fallacy that you can outthink the masses. If you can time it right, you can get there first, you'll win in the market. And that's a delusion. As Ken French put it in a Freakonomics podcast episode, and by the way, you should listen to that episode, link down in the description. As he put it, we fail to understand the negative sum nature of active investing. Whatever you win, I lose. Whatever I win, you lose. And we both paid to play that game. Granted, because commissions have disappeared, we're not paying as much, but just because we're not paying a commission doesn't mean it's free. Lastly, stocks are risky. Now, all investing is risky in some form or fashion. With stocks, we're looking at asset-specific risk, something to do with that particular company and their own decisions. You've got industry sector risk. Then there's market risk, the risk that the whole market might go up or down or get hit by an extrinsic or an intrinsic shock. Extensive studies going back to the 1950s indicate that you can eliminate or at least mitigate most of your asset-specific risk and a lot of the industry sector risk by investing in a basket of stocks. Essentially, by diversifying your holdings, you can eliminate 2 of the big sources of risk, or at least negate them. So if you're going to invest in individual stocks, you've got to buy a lot of them. 30 is the oftentimes quoted number. Sometimes studies show as few as 10 can be effective. But the fewer you go, the more carefully you have to choose them. Now, for those of you who say you're confident enough to pick stocks, let me just say this. The experts, the people whose job it is to know everything there is to know about a particular stock, the people who focus and study every single piece of available information about a few companies as their full-time job, sometimes they get caught with their pants down. Ask yourself if you know something they don't know, and if you have more time to research than they do before you invest. Even if you have the time, you got to look at how much time you're spending and what your time is worth to you. Now, I get it. Mutual funds aren't sexy. They're not exciting. The passive approach doesn't give you that thrill, but the returns could be superior over time, and you might be leaving money on the table. Now, if you feel like a baller and you got the kind of money you can just play around with, you got a couple extra bucks hanging around, you want to make some bets, go ahead. You probably should. It's not going to cost you anything other than the money you lose. But if you're trying to make the best long-term return, you might want to take a more hands-off approach. Now, if you're investing for the long term, trying to keep costs low and buying for tax efficiency, that's probably going to lead you down the path to some sort of broad-based index fund from Vanguard, Fidelity, or Schwab. And those have been free to trade for a long time, either as ETFs or as mutual funds, at least from the companies that offered them. So if you're doing it right, those new $0 equity commissions, they don't matter because you're not gambling, you're investing. If you find this kind of stuff useful, go ahead and hit the like button. Consider subscribing below and jiggle that bell so that YouTube will notify you the next time I post a new video. And if you didn't like it, you think I'm dead wrong, tell me below. Go ahead and hit that thumbs down. I can take it. Till next time, cheers.